Hey everyone, thank you so much for joining me here on this video. Today we are going to be talking about selling options versus buying options. Now, if this is your very first time here, welcome to the video, and if you've been here before, welcome back. My name is Kirk with Tactical Options Trading, and we make videos just like this on a consistent basis where we talk about the stock market and options trading. If you'd like to learn more, I hope you'll consider subscribing and clicking that bell so that you don't miss out on any future updates. All right, guys, let's get into it. So we're talking about selling options versus buying options. Why is one better than the other? Well, I really like to sell options, and I'm going to show you in this video why I like selling options. So if we're talking about in the option world, we can also talk about it as selling premium versus buying premium. So if you're a call option buyer, let's look at it from the call option buyer side. So a call option gives the buyer the right to buy 100 shares of the underlying stock or security at an agreed upon price, which is called the strike price, anytime in the future on or before expiration. So let's look at a profit loss diagram of a long call option. Now, when we're talking about buying or selling options, there's three ways we can make money or lose money, or there's just three ways we can make money. Let's just put it that way. So in this case, when we're looking at a long call option, the only way we can make money is if the stock were to move higher. And let's look at a profit loss diagram to kind of explain how this works. So when we're buying a call option, we have to pay a price. We pay a premium. So there's a debit in our account when we buy that option. So let's say we bought the $50 strike, and that $50 strike is represented by this point here. And let's say at that $50 strike, we paid $2 to enter this trade. So in order for us to make money, the stock would have to rise by $2. If we're trading one contract, that stock would have to rise by $2 by expiration in order for us to make money, because we have to make that money back. So if the stock were trading at 50 and we paid $2 for that option, we would not get paid at expiration. We wouldn't make any money unless that stock were above 52. So again, in the long call, the stock would have to move higher. There's no other way for us to make money. The stock would have to move. Now let's look at it from the seller side. Now when we're looking at it from the seller side, we're taking the opposite side of the trade here. So the seller of a call option obligates the seller to sell 100 shares of the underlying stock or security at an agreed upon price, which is again is that strike price, prior to expiration. Now let's look at a profit loss diagram of a short call position. So when we sold this call, we took in a premium, so we received a credit into our account. Now let's say again, we'll put it back into those terms that we were just looking at on the long call. Let's say we sold the $50 strike and we received a premium of $2 in our account. So we're on the opposite side of the trade. The buyer paid the $2, but we received the $2. So in order for us to make money on a short call, the stock would just have to stay below $50. So the stock could actually trade at $49 and $48. It could chop back and forth, and that stock really wouldn't even have to move. Or if it fell all the way down to $40, $30, we'd make money on this trade. So there's two ways that we can make money when we're the seller of a call or a put option. We're going to get into the put side here in a minute, but as a seller of an option, we can make money if the stock were to stay the same. Again, if that stock just chopped around right here, but it stayed below that 50 strike, because we've already received that premium when we sold that. And then if the stock were to move lower. So in this case, as a seller, we can make money in two ways. And that's why I really like selling options, is because it gives us more of an opportunity to keep that premium that we received. And the stock can just chop along and not do anything, or it can move lower and we can make money. All right, let's look at the put side now. So we're looking at the put side. So the put option buyer, now we're looking at the opposite side of the option chain here. So a put option gives the buyer the right to sell 100 shares of the underlying stock or security at an agreed upon price anytime in the future on or before expiration. Now, if you remember when we were talking about the call option just a few moments ago, the call option, we want the stock to be bullish if we're buying a call option. Now, if we're buying a put option, we want the opposite of that. We want the stock to be bearish. We're looking at a bearish move. So let's take a look at a long put. So we are the buyer of a put option in this case. So if we were to buy that put, let's say again, just to keep it nice and simple, let's say we bought the $50 strike and we expected that stock to trade lower, and again we paid a $2 debit in our account, because remember, every time we buy an option it is a debit in our account. So that stock that we bought at 50, or that $50 strike, it would now have to move down to $48 in this case for us to make a profit. So again, when you're a buyer or you're long an option, the only way to make money is if that stock were to move. So again, in this case, as a put option buyer, that stock would have to move lower. Now let's take a look at the seller side of a put. So if we're the seller of a put, we're basically bullish on the stock. So as a put option seller, the seller of a put option obligates the seller to buy 100 shares of the underlying stock or security at an agreed upon price prior to expiration if the buyer of that put option exercises their right to sell stock. Now remember, that buyer of that put has the right to sell stock. So as the seller of the put, we have to buy that stock from them if they put it to us. So if the buyer of a put option only makes money when the underlying stock or security moves down, where does the seller of a put option make money? Again, let's take a look at a short put profit loss diagram. So when we're looking at a short put, we're expecting, as the seller of that put, we want that stock to be bullish. So again, we took in a credit when we made this trade. We took in a credit. Let's say again, we're just talking about that $50 strike. And here's that $50 strike, and if that stock stayed above $50 in this case, we would get to keep that premium that we were able to collect when we sold that option. So let's say we collected a premium of $2. If that stock traded around $51, $52, as long as it didn't go below our $50 strike that we have right here, as long as it doesn't go below that $50 strike, we get to keep all that premium, because why would the buyer of that put want to exercise their right to sell stock? Because if they bought it at 50 and if it went up, they're expecting it to go down. They're not going to exercise that right. So we get to keep all that premium. So again, as a seller of an option, we get to make money in two ways. So again, the stock stays the same if it were to trade right above that 50 strike, or if it moved higher. So again, two ways as a seller of an option to make money, and this is why I like being an option seller. All right, so let's talk about selling premium. So selling premium, and that's what we're doing when we're selling the option. We're selling premium. So as an option seller, both on the call side and the put side, we would want to sell options when the implied volatility, or IV, of the stock is high. So selling when implied volatility is high allows us to sell options for a higher price and capture more premium. So what is IV? Or what is implied volatility? Implied volatility is what the market is trying to tell us about the future and is calculated using current option prices as input. Implied volatility is another way of saying how much do we expect the stock to move, or do we expect it to move a lot, or do we expect it to move a little? So implied volatility, if implied volatility is high, we're expecting that stock to have a lot of volatility and move a lot. But if that IV is low, well, we're not expecting that stock to move very much. And anytime that implied volatility is high, it gets priced into the options because people are more willing to pay a higher price for those options because they expect that stock to move into a range that could be profitable for them. So let's take a look at XLE, which is in the energy sector. It's the index for the energy sector. And I'd like to show you guys how the IV works and how it affects standard deviations. So let me pull up a chart here of XLE. All right, let's take a look at XLE here. So I'm going to bring an options chain of XLE in here. And what I want to show you guys is up here in the top right hand corner of the Thinkorswim platform, when we're looking at the options chain, you can see what the expected move is, or the one standard deviation move. And you can also see what the implied volatility is for that series. So for example, the November series of XLE, we're looking at a $3.89 move. Now let's look at the 21 December series, and you can see in that series we're expecting a $5.37 move, which makes sense, right? I mean, it's farther out. So people are willing to pay a little bit more for those options, expecting that stock to move into an area of profitability. So they're going to pay a little bit more for that. Now, I want to show you guys a quick little trick here to help you kind of find what that expected move is. And if you didn't have this right up here and you're on a different platform other than Thinkorswim, which automatically calculates this for you, let's say we're coming back here to that 16 November series. Now, if you just sell an at the money straddle, that'll get you close. So let's say, for example, we can see that the stock is trading right around $75.74. So let's just round it up here to 76. So if we were to come down here and click the 76 and sold that straddle, we sold the 76, and we're going to come in here and we're going to sell it on both sides. That's going to give us a $3.56 to sell that. Now, if you come up here and compare it to this number right here, it's about 389. So give or take just a little bit, if you plugged it all into the Black-Scholes model and everything like that and put them in implied volatility in there, it's going to come close, but this will give you just a rough estimate. So we're looking at $3.56, which is going to be, very close to this move right here. Now, let's just say we go out to that next series and we're looking at that 21 December and we do the same thing and we come at the money straddle and we sell that 76 and we come over here and do it on the call side as well. That's going to be $4.94. Now, it's close. It's not quite exactly right, and the market is closed, so these numbers aren't going to be quite accurate, but you can see that looking at this selling the at the money straddle is going to give you an idea of that expected move because those options already have that priced in. So that kind of gives you an idea of what to expect when you're looking at selling options and how that plays out into the expected move of the stock. All right, so eventually high implied volatility will return back to normal, and as this happens, the value of the options will decrease. Well, what do I mean by that? So let's again look at XLE, and I want to show you guys that there's different times when implied volatility is higher than lower. So if we're looking down here, I've got down here at the bottom, this is the IB percentile on my chart here. So you can see that at this point right here, the implied volatility was very high, looking right here in this range. And you can see that as time went on, that implied volatility started to decrease, and now it's decreased down to this point here. But implied volatility, especially if we're looking at stocks with earnings coming up. Let me just pull up, let's say Amazon, for example. Let's say we looked at Amazon, and you can see all these little icons down here represent earnings, right? So you can see that as we approach earnings, implied volatility starts to increase, and then after earnings, it decreases because the stock has made its move and everybody understands what's going to happen. So again, right here, implied volatility increased right after earnings, it got crushed. Again, implied volatility increased, and after earnings, it got crushed. So we want to sell options when the implied volatility is high because we can collect more premium by doing so. And so we look for options, we look for times in the market where the options are going to be a little bit higher priced, and we can use those implied volatility charts right there, those indicators, so that we can see when implied volatility is high, and that's when we want to sell implied volatility. And then as the implied volatility is low, that's a time to buy because you're not paying so much for those options. Hey guys, that's going to do it for us here at Tactical Options Trading. I hope you enjoyed this short video on selling options versus buying options. Consider liking and subscribing. If you find this video helpful and you think somebody else might enjoy it, consider sharing it with a friend. We make videos just like this all the time, and we'd love to have you on board. My name is Kirk with Tactical Options Trading. Have a good one. We'll catch you later.